Welcome to today's episode. Let us take a quiet, deliberate breath and look at the reality of the market today. Sometimes the numbers tell a story of rapid growth, but other times they serve as a stark warning of a steep cliff. Today, we are focusing on a company that has captured a lot of attention in the basic materials sector, ASP Isotopes Inc., trading under the ticker ASPI.
It is a fascinating case study in market psychology and technical setups. ASPI has had a wild ride over the last year, reaching heights of nearly $14.49. But as of our latest data from July 2026, it is sitting at just $5.63. That is a massive retracement.
A sobering reminder indeed of how quickly sentiment can shift. For a small cap company with a market valuation now sitting around $468 million, these swings can be brutal. Let us dissect what is actually happening behind the scenes. Why did the stock drop over 8% in a single day, and where is the bottom?
To understand where we are, we have to look at the momentum. The technical picture is incredibly heavy. If you look at the moving averages, they are pointing straight down. The stock is trading below its 10, 20, 50, 100, and 200-day moving averages. In technical analysis, that is what we call a clean sweep of bearish indicators.
A clean sweep, indeed. It is like trying to swim upward against a heavy waterfall. When a stock is trading below all major moving averages, the path of least resistance is almost always lower. But what about the oscillators? Are they showing that the stock is oversold? Perhaps ready for a sudden bounce?
You would think so after such a drop, but the oscillators are actually sitting in a neutral zone. The relative strength index is at 42.67. The stochastic oscillator is around 22. They are leaning toward oversold, but they have not crossed that threshold to trigger a strong buy signal. The MACD is also negative at minus 0.18, signaling that the bears are firmly in control.
So the selling pressure is strong, but the spring is not yet coiled enough for a rebound. That is a dangerous place for retail investors who like to catch falling knives. What makes it even more concerning is the sheer volume of bearish candlestick patterns appearing on the charts.
It is almost unprecedented. The US Stock Picker podcast channel analyzed the charts and flagged over 50 bearish candlestick patterns. We are talking about classic indicators like three black crows, bearish engulfing, evening star, and hanging man. When you see that many patterns aligning, it means the market is actively distributing shares.
And who is doing the distributing? That brings us to the insider activity. If we look at the filings, we see some highly telling transactions. In late June, the Chief Operating Officer, Robert Ainscow, sold over 8,000 shares at around $6.99. And just a day ago, on July 3rd, insider Michael Gorley sold 30,000 shares.
Exactly. When the executives who run the company are selling their own shares, it sends a clear message to the market. Combined with a lack of major positive catalysts, it explains why the market cap eroded by nearly 40% in just a 3-day window, dropping from over $770 million down to under $468 million.
That is a staggering loss of value in such a short period. It indicates panic selling, a rush to the exits. Yet, if we look at the actual business operations, the earnings calls paint a slightly different picture, don't they? The Q1 earnings transcript from mid-May showed that the company is executing on its milestones, like restarting the Silicon 28 facility.
Yes, the fundamental tone from the earnings calls has been neutral. There are no major operational disasters, but there are also no major new contracts or revenue breakthroughs to get excited about. They are doing the work, but the market wanted immediate results. Without new revenue streams, the high valuation they had earlier simply could not hold up.
So the business is steady but quiet, while the stock price is loud and falling. This divergence is exactly what swing traders look for, though perhaps not in the way most long buyers hope. Let us talk about the structure of a swing trade here. If the trend is clearly down, how should someone approach this?
Well, if you look at the price action over the last 2 months, ASPI rallied from about $5.16 in May to a peak of $8.33 in early June. That was a massive 61% rally, but then it reversed sharply. It attempted a bounce in mid-June to $7.28, but that failed, and now we have broken down to new lows.
It is a classic series of lower highs and lower lows. The immediate support level to watch is $5.25, which represents the May consolidation zone. If that level fails, the next support is down at $4.32, and the absolute floor is the 52-week low of $3.92.
Right. And on the upside, resistance is waiting at $5.71, then $6.64, and finally the major resistance zone near $8. Given this setup, the path of least resistance for a swing trade is actually a short position.
Let us summarize our strategic outlook for those listening who are trying to navigate these turbulent waters. We must look at this through a highly structured lens. First, the news sentiment is neutral operationally, but leans negative due to heavy insider selling. Second, from a fundamental perspective, ASPI is a small-cap basic materials play, making it highly volatile and sensitive to market panic. Third, the swing trade analysis strongly favors a short bias rather than trying to buy the dip.
That brings us to the crucial question: when and how should an investor take action? If you are looking to start investing or buying this stock, our recommendation is to wait. Do not buy at the current price of $5.63. You should only consider a long position if the price holds the $5.25 support level with a clear bullish reversal candle on high volume, or if it reclaims the resistance at $6.64 with strong conviction.
And if someone chooses to take the preferred short swing trade route instead?
For an aggressive short trade, the entry zone would be right here between $5.60 and $5.80. To mitigate risk and protect your capital, you must set a strict stop loss. We recommend leaving the market if the price rises above $6.20, which is just above the recent consolidation zone.
And where should they look to take profits on that short trade?
The target price points to exit the short trade and capture gains are $5.25 for target 1, $4.32 for target 2, and ultimately $3.92 if the stock tests its 52-week low. Managing risk is everything in a downtrend. Never average down on a losing long position when the trend is clearly your enemy.
Wise words. The market always tells us a story through its price action, and right now, ASPI is telling us to proceed with extreme caution. Thank you for walking through this analysis with us today. Keep your risk managed, pay attention to the levels, and we will see you in the next episode.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.
SEO video. Title: Is ASPI stock a giant trap? Crash analysis and growth stock. Picks: Stock Trade podcast, upside potential stocks, technology stock predictions, pop stocks.